Monday, September 4th, 2023, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at how the mountain or pile of debt in the major Western countries are converging with rising interest rates to create really an environment that is chaotic, not just for the financial markets, but for the economy. And I'm not trying to be negative. I'm just looking at maths here. Even though maths really was not my best subject in school, it became a lot better when I worked in the city of London in finance. You get used to it. And yes, and I think people can thrive in such an instance. And that's what I want to talk a little bit about before I go into this cocktail of disaster, so to speak. So I grew up in Brazil. I was born in 1964, hence Monaco 64. My dad was called Mario as well, so he gave us all, me and my sisters, a nickname right off the bat. Mine was Monaco, Mario Ineco, and that's why my YouTube channel is Monaco 64. Even though I was fortunate because my father was in a business that thrived in the 60s and 70s and up to the early 80s. He was in shipping, in the oil business, and but I could see what was going on in Brazil. Inflation, a lot of poverty, a lot of wealth inequality. And that's one of the reasons why I've always had an interest in economics and inflation. I remember back in the 70s, early 80s, we had massive inflation, several currencies, and nobody really knew what the problem was. Of course, if you had dollars at the time, it helped. So what I'm trying to say here, it's not all gloom and doom out there, but I think the first step of surviving and maybe even thriving, and that's not guaranteed, of course, is knowing what's happening. And that's why I've been talking about stacking gold and silver since I started this channel back in 2015. I've been talking to friends, colleagues, and family since 2002 not because I have a crystal ball, but because I've read through the history of money, the history of fiat currencies and how they end up. So even though I can't tell you exactly when it's all gonna implode, it will one day. And it's better to be prepared than to be one day late. So yes, if you're interested, and I didn't start this channel to do this, but the viewers have kept asking me, where can I buy gold and silver? So I've affiliated myself with people that I trust. I've got ITM Trading in the US and Miles Franklin. All the details are below in the description. In the UK, I've got Gold Investments and Glint. And the details are below in the description as well. So back to the main topic here. I'm going to first show you a chart of the US 10-year yield. And it's going back all the way to just around the time of World War I. Yes, way back. I think it's December 1912. So even before the Federal Reserve was created. And you can see that from 1920 to 1942, the 10-year yield dropped. So there's a bull market in bonds there for about 22 years. And we dropped from 5.9 all the way to just below 2%, just when the US was entering World War II. And after that, it was a bear market for bonds because yields went up. For those of you who don't know, rising yields for bonds mean that the prices are going down. How does that work then? Well, let's say Uncle Sam issues a bond at par. He pays a coupon of 5%. And that bond then starts trading in the secondary market. And existing bonds and rates start going up, let's say to 6%. So for that 5% coupon bond at 100 to trade at 6% yield, the price has to drop. So that's how it works. It's fairly simple. I mean, I worked in the bond markets all my financial career, so it was one of the first things I was told when I met some bigwig in Geneva. A friend of my dad arranged that I meet with him to talk about bonds, and that's the first thing he said. When bond prices go up, yields go down, and vice versa. But anyway, so we had a bear market in bonds because yields went up, prices went down. Back in the 70s when the yields really picked up, bonds were called certificates of confiscation. And why am I talking about bonds? Well, because they're very important in terms of the debt. So here we are, 1981, the 10-year yield topped just below 16%, which at the time was I think it was probably the highest yield ever seen, maybe except for during the Revolutionary War, maybe during the Civil War. I don't even think it got up that high. But ever since 1981, those yields, the 10-year yield, the trend was lower. You had lower highs, lower lows. And that's one of the reasons why Uncle Sam was able to borrow so much. The US had just under $1 trillion, I think, of debt, national debt, back when Reagan was inaugurated in 1981. And now we're almost at, I think, 33 trillion. And one of the reasons that's been possible is because investors, the markets, have been expecting yields to keep dropping, and the more yields drop, the more valuable bonds become, the more investors want to buy it because there's something called capital gains. There's not just the coupon that you clip every 6 months with US Treasuries. It's semi-annual. In Europe, most of the government bonds are, the coupon is annual. So yeah, they've been making money on the capital part because the bond prices have been rising in the secondary market, and especially until March 2020, when we saw a huge drop in the 10-year to a historic low of 0.3. In Europe, of course, we've seen bonds like the German government bonds go negative, even in the 10-year maturity. But look at what it's done since then. The yields, they've really picked up, and they haven't stopped. And even though the jobs data on Friday were not that great, really, for the economy, the 10-year yield went up 10 basis points, which I think was surprising. Yes, the headline number was higher than expected, but the previous month's number was revised down quite a lot. Hourly earnings, which is something that the market watches for Fed's perception of inflationary pressure, that was a lot lower than expected, the growth. And initially, I saw that the 10-year yield didn't move much, but at the end of the day, it was up almost 10 basis points. Why is that? Well, I think it's because, as I said, this cocktail is converging. As I see it here, the almost 40-year trend of declining yields, rising bond prices, lifting all boats, so to speak, not just in the government bond market, but corporate bond market, mortgage market, municipal bond market. That's over, and it's now reversing. And the problem with our current system, the fiat currency system, is that it can only keep going with more debt. But if the debt is becoming more expensive, it's going to overwhelm the system. And one of the reasons I'm talking about this today is because I saw this tweet here from Lawrence Lepard, and he's retweeting or reposting, as they call it now, because Twitter is called X. And he says, "This is not sustainable, full stop. The stadium is filling with water." So Charlie Bilello, this is what he said: U.S. national debt has now increased by 1.45 trillion since the debt ceiling was suspended 3 months ago, and is fast approaching 33 trillion. In the past 5 years, the national debt has increased 53%, from 21.4 trillion to 32.9 trillion. So if you look at this chart, he's looking since September 2018. And I would say the bulk of the increase was around the period up to 2020. And you saw in that chart that the 10-year yield was going down to like 0.3. Short-term rates were down to 0. So it was easy for Uncle Sam to borrow. And there's a lot of, I don't like to use the word, but a lot of stupid fund managers and investors out there who thought it was good to buy bonds. I guess SVB learned the hard way, even though their big depositors got bailed out by you, the taxpayer. But anyway, I thought that was really interesting. And Lawrence Lepard used this stadium is filling with water analogy. And this is this analogy to do with exponential growth. And the example is this, and I'm going to read from this page here, website. It says, here's Wembley Stadium. The watering system develops a fault. In 1 minute, 1 drop of water is released. Minute 2, 2 drops. Minute 3, 4 drops, and so on. Every minute, the number of drops doubles. How long will it take to fill up Wembley Stadium with water? The answer is that after 44 minutes, so before halftime, the stadium would overflow. And they go on to talk about why, all the maths, all the equations. Of course, in football, Americans call it soccer. Each half is 45 minutes, so 44 minutes. And now I want to show you another chart to do with interest payments for Uncle Sam or the federal government. And notice how it's starting to really take off here, and it's fast approaching $1 trillion. And I wouldn't be surprised for it to reach $1 trillion soon. This is from the second quarter of this year, 969 billion. And look how it's been picking up really since around the low in the 10-year yield in March of 2020. So I thought that was interesting. And the higher Treasury yields go, the worse things are going to get. Those drops of water are going to accelerate, and it's going to overwhelm everything. It's going to crowd out, the private sector is going to crowd out investment. And some people might say, well, it will be a good time to buy bonds. I'll be able to get 6-7%. Well, maybe in the very short term, you might be okay buying a 1-month T-bill, but not anything longer, I would say. Don't forget, in the 70s, treasuries were called certificates of confiscation. And I would say tangibles, hard assets, they're going to be the best things, because interest rates and bond prices, they're the rates used to discount future earnings and the price of financial assets. And the higher these rates go, the less value these assets get. And that's why we saw 2022 as the worst year for stocks and bonds in many decades. And this year, I guess some of the tech stocks have done better, but I don't think it's over by any stretch of the imagination. So I know it's a Labor Day today in the US, but the markets are still open. So let's have a look at where they are. So it's 8:20 a.m. London time. We got spot gold, 1943. It's up just over $3. High's been 46. Low's been 38. Silver's trading at 24.10. It's down 7 cents. High's been 31. The low's been 08. The Dow futures is up 30. NASDAQ 100 future is up 32. And the S&P future is up 4. Sterling is up 0.25%, 126.23. The euro is up 0.25 as well, just above 108. The dollar is unchanged versus the yen, 146.21. Unchanged versus the yuan, 726.75. Dollar is, it's actually slightly higher versus the ruble at 96.39. Not that much higher though since Friday. Let's look at the Aussie dollar. Aussie dollar is up 1/3 at 64.70. The dollar is unchanged versus the loonie, 135.87, and the Kiwi dollar is up slightly at 59.50. To the commodities, WTI crude trading just above 85. It's down 0.1%. Brent is at 88.40, down 1/8 as well. Platinum is unchanged, trading around 962. High-grade copper is down 1/3% at 384. It looks like treasuries are trading here in Europe. Usually they don't trade on a holiday, but the 10-year yield is at 4.20. It's up just under 3 basis points. The UK gilt market, the 2-year is up 7 basis points at 5.25. 10-year is up 6 at 4.49, and the 30-year is up 6 as well at 4.76. So with that, I'm going to wish you all a very good day. Take care. Bye.